Hey everyone, thanks for jumping back into the Macroverse. Today, we're going to talk about what needs to happen to actually improve the real estate market. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. Over the last few months, you'll see a lot of people call for the Fed to lower interest rates to make housing more affordable. Now, while it is true that the Fed will likely lower rates later this year, and while that may improve shorter term loans, I think it's prudent to make everyone aware that lowering interest rates does not inherently make housing more affordable. In fact, there are cases where lowering interest rates can actually make housing less affordable. So I want to talk about that. And then I want to talk about what actually has to happen for housing to become more affordable. So today, there are a lot of people around the world that are completely priced out of real estate. And one of the reasons for that is because prices are so much higher than they were 4 to 5 years ago, but mortgage rates are also so much higher than they were 4 to 5 years ago. So for someone looking to purchase a new home today, it's a lot more expensive than it was just a few years ago. So a lot of people have been completely priced out of the real estate market, or at least priced out of the market they could have afforded, or the house they could have afforded only a few years ago. And so ultimately, what I want to talk about is why there's this misconception about the Fed lowering rates will then make housing more affordable. You could argue the reverse is actually true. And I know that it sounds crazy when you first say it, but when you actually look at the evidence, I would actually argue it's largely indisputable. Okay, so there's this idea that the Fed controls mortgage rates directly, but the Fed does not control mortgage rates directly. The reason for that is because mortgage rates are more so dependent on the long end of the yield curve. In fact, mortgage rates, 30-year fixed rates, tend to trade about 1.5 to 2% higher than the long end of the yield curve, right? Like the 10-year, 30-year yield. Right now, the 10-year yield's at 4.2%. 30-year fixed right now is about 6.2%. So the reason why there's a spread is because there's risks associated. When someone takes on a loan, there's credit risk, there's other types of risk, and that's one of the reasons you get a spread between where the long end is and what you can actually get a loan for, right? There's a risk, and that's how they compensate for that risk, right? That's how the bank compensates for that risk, is by having that spread. Now, one of the things that you've heard a lot of people say over the last few months is they call for the Fed to lower interest rates to make housing more affordable. Now, it is true that the Fed will likely lower interest rates this year. They actually are projected to lower interest rates in September, according to the markets. Now, things could change between now and then. We're going to have more labor market reports. We're going to have more inflation readings. So who knows? But do note that last year, the Fed lowered rates in September. It tends to be a weaker time in the year. September just tends to be a weaker time. And so if you couple that with, a labor market that's starting to weaken, then you likely would see the Fed lower interest rates. But I want to show you how just because they lower rates does not actually mean that mortgage rates go down. It depends on why they're lowering rates. Okay. The last time the Fed began cutting rates was actually in September of 2024. This blue line right here, this is interest rates, right? This is the Fed funds rate. And what we're looking at on this chart is the 10-year yield. Okay, so the blue line, the Fed funds rate, interest rates, and these candles are the 10-year yield. What you notice is that when the Fed cut rates, a lot of people assumed wrongly that it would make mortgage rates go down, right? They thought, oh, well, if the Fed lowers rates, mortgage rates will go down. What actually happened? The long end went up. And when the long end goes up, mortgage rates go up. Take a look at this. Look at these mortgage rates. Let's just look at 30-year fixed over the last year. Do you see where they found a bottom? In September, when the Fed lowered rates, right? 30-year fixed back then was all the way down at according to this chart, right? 30-year fixed here, 6.11%. After the Fed lowered rates, the 30-year fixed rallied to 7.2%. It's still well above where it was before the Fed lowered interest rates. Now, why is that? The reason for that is because if the Fed lowers rates, it ignites some of the animal spirits as long as the macro economy is not falling apart. So, for instance, if the labor market is still holding up and not completely collapsing into a recession, if the Fed lowers rates preemptively to try to avoid a recession, it can actually reignite the animal spirits in all of us. It can cause markets to go up, which is not a bad thing, right? Everyone wants to see the markets go up. But the problem is if that stuff goes up, it causes the bond market to then reprice inflation risk, right? The bond market starts to reprice the acceleration of inflation, and then it starts to worry less about a recession, and it worries more about inflation if the economy starts to accelerate again. So if the Fed cuts preemptively, which is a good thing for the Fed to cut preemptively, right? It's a good thing. You don't want to go into a recession. But the problem for the housing market is if the Fed cuts preemptively, then it can actually cause mortgage rates to go up. And that's exactly what happened in 2024. There's a lot of people that have been around the markets for a long time that have only seen, the Fed funds rate go down. And they've only seen the long end of the yield curve go down. I think what a lot of people are potentially missing here is we could be seeing a shift in this overall trend, right? Because once you hit zero, there's not really anywhere left to go, right? Except to go back the other way that you came from. So there's a lot of people that are basing all of their expectations on what's going to happen on this trend here. But we've already gone to the zero bound. There's only one direction left to go, and that's probably to stair step this back up, right? It doesn't mean that it won't go back down. We could see the long end go back down, to 3% or something. But the point is I think so many people have based all their assumptions on this move. They're not necessarily prepared for it to potentially staircase itself back up. And there's so much evidence for the idea that the Fed cutting rates will make housing less affordable, but so many people, especially on X, on Twitter, and these talking heads, will completely ignore this, right? They'll completely ignore the fact that cutting rates in September actually made mortgage rates less affordable. And they'll say today that, hey, if the Fed cuts rates, it'll lower mortgage rates. But that's not true if the Fed cuts too soon. The only way what they say could be true is if the Fed keeps waiting to cut rates, and then they cut rates when it's too late and it's in a recession. If they cut rates in a recession, then absolutely the 30-year yield's going to go down. But the 30-year yield will be going down not because the Fed's cutting rates. The 30-year yield's going down is because by that point, because it's more concerned with a recession than inflation. And so that is the difficult thing right now. And so what has to happen? I mean, look at the housing market. This chart here shows new privately owned housing units under construction. It's dropping, right? This thing has been dropping. And why has it been dropping? Because people can't afford housing, right? So you're not going to have a lot of new builders build a ton more housing if people are priced out of housing, right? There's just not the demand. So how do you bring back the demand? How do you bring back demand for housing? Well, lower housing prices would be one. Lower interest rates would be lower mortgage rates would be another. How do you get lower mortgage rates? The way you get lower mortgage rates is to not lower interest rates on the short end. Because if you lower the short end too soon, it sends the long end higher. So how do you get lower interest rates? Or lower long-term rates, lower mortgage rates? How do you get lower mortgage rates? You need lower asset prices, right? You have to have lower asset prices. look at what ultimately caused a lot of these downturns in the housing market to turn around, right? It was lower asset prices. And so I think that it's going to take some time for people to accept this reality. But the only way that the long end really goes down durably is to have lower asset prices. And that is not yet something that I think a lot of people are willing to accept. I think it's maybe going to take a few more months, maybe 6 months, maybe 12 months for people to accept that reality. But I ultimately do think it's a reality that will get accepted over the next couple of years. And one thing you should consider here with with mortgage rates and how this all sort of plays back into itself um, is that if you look specifically at the S&P 500, you see when we had lower asset prices, overlay the 10-year yield onto the S&P. What you'll notice is that when the market drops, that's when you get 10-year yield going down a lot of times, right? That's when the 10-year yield goes down, at least in the last couple of years or so. The market dropping corresponds to the 10-year yield dropping. So if you truly want a more affordable housing market, you're ultimately going to have lower asset prices. Without lower asset prices, you're not going to get, in any durable fashion, an affordable housing market. The reason for that is a lot of people that buy homes, they also own assets. If their assets are increasing in price, you have the wealth effect, right? And so why should people wait for the housing market to drop? This is what they think, right? Why wait if they still feel rich? And so it just leads to this pressure on housing to not actually fall back down. It leads this pressure on housing where mortgage rates aren't going to fall back down because you don't actually have lower asset prices. When we had that crash back in April, or between February OPEX and early April, which is what we said, right? I mean, that's what we said when the crash was going to be. That crash led to lower mortgage rates. So you have two things being said, or two things actually happening. You have some people saying that you need lower mortgage rates, or you need the Fed to lower rates to have lower mortgage rates. That's not true. In fact, all you have to do is look at last year and see that the exact opposite occurred. Lowering interest rates led mortgage rates to go up, not down. I don't think people are willing to accept that yet. What happens if we get to September and the Fed lowers rates and everyone cheers it on, and then the long end of the yield curve goes to 5%, right? The 10-year yield, what if the 10-year yield goes to 5%? I think it's going to take people living through that to actually accept that reality. So the way I see this playing out is people still believing that the Fed lowering rates will make mortgage rates more affordable. But I think after we have a second round of rate cuts, starting potentially in September, I think it's likely going to make the long end of the yield curve go up when they cut rates. And I'm not saying they shouldn't cut rates. I'm just saying it's not going to make the housing market more affordable. It might make other things more affordable, like car loans and other stuff, but it's not going to make housing more affordable. So I think what's going to happen, I think they're going to lower rates. People are going to cheer it on, but then it's going to lead to the long end going up. It's going to cause the long end of the yield curve to go up. When the long end of the yield curve goes up, it's going to make mortgage rates go up. And only after all of that happens for the second time, because it already happened last year. It happened last year, and a lot of people just want to ignore it. If it happens this year, if it happens 2 years in a row, I think it's going to be hard for people to ignore. And once that happens, once people can finally no longer ignore it, then I think the market will accept lower asset prices are needed to improve the real estate market, and that's how I think this is all going to play out. And then the reality will set in, hey, in order to improve this, we need lower asset prices, and then the market will finally roll over into those lower asset prices. The 10-year yield will come down, and then the Fed will cut rates again. But again, by that point, they're not going to be cutting rates to improve the mortgage market. I mean, the long end of the yield curve would already be going down. They're going to be cutting to just try to stimulate growth again. So again, this is a process that's likely going to take a couple years to play out, at least, probably longer. But I just want people to be aware that there's a lot of talking points that are presented on Twitter or on X and on YouTube, where these people will sort of just go off and say that the Fed has to lower rates to revive the real estate market, but they're completely ignoring the actual indisputable evidence that lowering rates prematurely, while I'm not saying is necessarily a bad thing, it can be helpful in certain areas, but lowering rates prematurely does not help the real estate market. In fact, it arguably makes it worse. It arguably makes it worse. In fact, in order for the real estate market to actually improve, higher for longer is needed, right? The higher the short end of the yield curve is, for longer, the longer that's the case, that will actually lead to lower asset prices, which then leads to lower mortgage rates. So the problem is that a lot of people want something to occur. They want lower mortgage rates, but they're not willing to accept what's needed to have it, right? It's kind of the same thing with Ethereum that we talked about. I know if you're probably watching this, you're probably wondering where did that come from? But it's the same thing with Ethereum, right? In order for Ethereum to have bottomed against Bitcoin for this market cycle, it had to go home. But think about how many people would not accept that over the last couple of years, right? No one wanted to accept that Ethereum had to drop down here for it to finally get a nice rally and for ETH Bitcoin to finally bottom. So in order for Ethereum to go up on its Bitcoin pair and potentially bottom out for the cycle, ETH USD had to go where no one wanted it to go. So the same thing can be said about the housing market. In order for demand to return and for this chart to turn back around, in order for that to happen, you have to have lower asset prices, as history shows us. It's just a matter of time for people to accept it. And once they accept it, then that's more or less what's likely going to play out. Lower asset prices will then lead to a lower long end of the yield curve, and then people might actually be able to afford houses again. Now, there's a lot of people that might say, well, if lower asset prices occur, then they won't be able to afford a house because, well, their stock portfolio will be down. But you have to remember there's different people in the world, right? There's a lot of people that don't invest in the markets at all. And I think that's a foolish thing. I think, one of the only ways to really get ahead, if you're not starting your own company or something like that, one of the main ways to get ahead is to invest. There's a lot of people that don't do that. And so those people get priced out. The only way that those people are probably going to come back to the table, to the real estate market, is for mortgage rates to become more affordable. And that's not happening until you get lower asset prices. Again, this is going to take many, many months to play out. And I could see it play, I don't think people are going to accept it, at least for another 6 months. And by that point, I think all the narratives will have played out, and I think there will be indisputable evidence that the Fed acting prematurely does not improve the housing sector. And I've always said that one of the things that people have a hard time with is they don't want the facts to get in the way of a good narrative. The fact is that in periods of high inflation, or just in a cycle where inflation is a concern, when the Fed cuts rates prematurely, it causes the long end of the yield curve to go up. We can argue about it all day, and you can argue about it with whoever you want to. But the fact is right there. The Fed lowered rates, the 10-year yield went up, and mortgage rates went up. And now we're all going to make the same mistake again. We're all going to call for lower interest rates to make mortgage rates go down. Mortgage rates are likely going to go right back up. And then only after we've gone through that cycle a couple of times, I think, will people finally accept it. But that is how you ultimately fix the real estate market, through lower asset prices that lead to lower mortgage rates and bring people back to the table. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.